engagement of the non-farm payrolls for the month of September. So we're expecting something very, very exciting in the lead up to these NFP details. Basically, last month where we saw a bit of a letdown in job numbers at the 235,000 level, now we're expecting almost double at 500,000. But when it's such a round figure, there could be a little bit of a speed bump in the way. So we'll see if that comes into fruition at least, especially. And also we are looking that the unemployment rate is going to be slightly lower at 5.1% rather than 5.2%, and average hourly earnings are allegedly going to be higher as well. So we'll see if that comes into fruition as well. And you know, we've got the obvious elephant in the room, let's say, of the tapering issue, and obviously the fact that the Fed will allow its debt buying to continue a little bit longer. So we'll see if that hampers the, let's say, the long run or the short term especially. But first of all, without further ado, just got to go through a quick risk disclaimer. So foreign exchange, trading and investment in derivatives and CFDs can be highly speculative and may result in losses as well as profits. Foreign exchange and derivatives trading is not suitable for many members of the public, and only risk capital should be applied. This webinar is provided for information purposes only, and no information contained herein constitutes a solicitation for the purpose of the purchase or sale or any commodity, security or investment, nor should it serve as a basis for any investment decision. Orbex Limited does not guarantee the accuracy or completeness of information or analysis supplied. So without further ado, I'm just kind of in the way of a few months ago, so I hope that's fine. So basically, as I said before, we are expecting or are looking like we're going to have almost double the amount of jobs added for last month, after we had a bit of a lackluster NFP in the previous months. Data, which you can see here, 235,000, after actually hitting over 1 million new jobs for the first time in a long time. Actually, this was actually revised. It was just under 1 million. It was roughly about 950,000 if I remember correctly, but then it jumped. It was revised over 1 million, which is quite significant. And as you can see here, from April, we have had a steady upturn in jobs numbers, but now we're falling down again. So as you can see here, it is a similar pattern from when we had it at the beginning of the year in January. We had a 233,000 jobs added, then the 500,000 mark came, and then 785,000, and then it dropped, and now we're picking up, and now it's dropped again. We're looking at this 500,000 again. So you can probably expect that the next month it'll be around the 700,000 region. However, let's see what's going to happen with that. So August data, which was last month's release, missed expectations, as we said, by a whopping over 500,000. And as I said, we are looking to dip down. This has been revised now to 5.1%, and it's expected to be is expected for the unemployment rate, which will be the lowest since March last year. So unemployment is actually getting steadily better from when we were really fully in the pandemic as well, which is again quite significant. Average hourly earnings are expected to be shaken up a little bit, but we'll see if that's going to come into fruition as well. And jobless claims remain below the 500,000 bracket, which we'll look at a little bit more in depth shortly, and as well as the ADP figures as well. Private businesses really pushing to add more jobs in that region as well. So we'll see if that happens. The ADP figures handsomely beat expectations, so we'll see if that's going to come into fruition. But yeah, looking at the chart for the NFP numbers in general, very, very buoyant, and we'll see if we're going to have another leg to the upside as we go into the back end of the year, into Q4 now. Very, very significant as well. So let's just take a look at some more data, analyst expectations again. So unemployment claims dropped to another low of 326,000 this week. So as you can see here, the unemployment claims from the beginning of the year, we've steadily started going down. There's been a few bumps in the road, but as you can see, very, very significant. Once we got under the 500,000 mark, we did not look like it was going to start turning upwards anytime soon, even though there is a little bit of a problem with the jobs at the moment that employers are refusing to pay employees certain salaries. Some people are ready to just keep staying at home, even though the weekly benefits will stop shortly as well. So there is a potential for optimism that people will start getting back into work at least. But as you can see here, the downturn for the unemployment data is very, very significant, and it goes a long way. And this is on a weekly basis as well, so it's very, very significant. You don't have to wait every month for this. This is the lowest level in a month and ends a 7-week period high of 364,000 in the previous period. As I said, private businesses saw the highest hiring rate in 3 months and jumped over the 500,000 mark. So, why is there an optimism for ADP employment? Well, the ADP has lost some of its predictive reputation, let's say. In the final week of September, the number of people seeking unemployment started creeping upwards. However, we did have some good numbers as well in the last few weeks prior to this, and the argument is that people aren't returning to work because of the recent factors. They are getting salaries to stay at home, and also employers are refusing to raise wages as well. So a lot of things to take into account when we're looking to trade on these big numbers. Annual inflation rate in the US eased to 5.3% in August, matching market expectations. But as you can see here, the big upswing in inflation from the beginning of the year is very, very significant as well. And that's even from the pandemic low. Obviously, when the pandemic hit, inflation rates have gone a bit we've had record lows in these inflation numbers. So that's, again, something to keep an eye out for. And as I said just now, employers have been complaining about the struggle to fill open positions, citing ongoing labour shortages due to ongoing benefits, which are apparently going to end soon. So we'll see if that's going to have an impact on the numbers as well. So just having a look at which economic indicators are we looking for, what is significant in the market on a monthly basis and also a weekly basis going into this jobs number as well. So ISM, manufacturing, non-manufacturing, this is manufacturing services, PMIs, business conditions in manufacturing service sector signals an increase or decrease in employment activity. This has been very, very transparent in the last year that manufacturing sectors have actually increased quite significantly, and so has services as well. We've seen the service sector, hospitality, transportation, tourism, etc. These have really started to pick up quite significantly, and with a lot more countries now taking, being a bit more relaxed and having relaxations in travel, this could actually help this sector even further. Challenges, job cuts and jobless claims. Jobless claims we just touched upon. Challenger job cuts as well. These are quite significant. Shows information on layoffs and how many people claim for unemployment benefits. And as I said, this is weekly versus monthly. So the weekly target is very, very good for jobless claims at least. And that gives us a bit more impetus to put in bids, especially if we're looking at good numbers. ADP provides monthly employment data in the private sector, as we just looked up on as well, and consumer confidence, University of Michigan and the CCI. So University of Michigan been going on for a long time now, a very big survey going over 60 years, and it gives a rough estimate of what the impetus is for the people that have been questioned for this survey in the University of Michigan. And we've got leading as well, leading Treasury Yields and equities and crude oil prices. So crude oil in the last few sessions has had a bit of a topsy-turvy run for its money. It's been making significant gains yesterday after dropping $3 in the previous session. Now today it's trading a little bit flat, but it went down to the regions of $75. And now it's trading just above $78 as we speak. So, as I say, it's a little bit flat today. It's gone up and down quite in a zigzag pattern, let's say. But at the moment, it has erased all the gains pretty much that we saw a couple of sessions ago, where it did take a little bit of a hammering. So something to look out for with crude oil. And going forward, we've had the OPEC decisions as well. And also, we've got a lot of the G20 summit really pushing for a greener future, and this is why we have to keep an eye out for vehicle stocks that are really investing in electric vehicles, such as Tesla, who are the front runners, and also Ford and General Motors that have actually done big investments in the last few weeks as well, and promises to keep that going. So we'll see if that comes into fruition as well as we go into coming up shortly, just 15 minutes to go before the NFP figures. So just looking at the figures here then, so as you can see, there are a few more pros than cons. Looking at, as I say, jobless claims, ADP was very good. University of Michigan sentiment was pretty good as well. Core retail sales, though, they took a surprising move to the upside. It was actually revised following a fall in July, and unexpectedly revised to 0.7% in a positive. So that was very significant as well. Previous month before was in negative, and just before that we had a positive reading as well. So when we had the big grand reopening in the middle of the year, just as the second quarter came into fruition, if I remember correctly, we had over an 11% increase in retail sales in America. So that was very, very significant as well. But now we are trading just above negative territory with the retail sales, so something to look at there. Treasury yields are just slightly down. This was just before I came on air. Equities and crude oil. Crude oil has just been revised to 0.4%, and for today so far, but it is looking like it's just going to possibly end around the $78 region, even though it was looking to push for $79 at one point. So that was quite significant as well, because it's going to fresh highs at the moment. If you think of this time last year where it was on its record, into negative territory, which was quite something to think about. And looking at countries' interest rates. So the main talking point here is New Zealand, that have increased the Reserve Bank of New Zealand increased their interest rate to 0.5% for the first time in 7 years. And actually it's one of the big economies to only change or increase their interest rate decreases during the pandemic. So it is interesting to note that if New Zealand have started, then this could lead to other central banks doing the same, or will it? I mean, we have Australia, which is right next door. Apparently New Zealand were going to do it earlier. However, they had a vast outbreak of COVID, which they had to do another lockdown, so they didn't want to change their rates too quickly. So we'll see if that comes into fruition anytime soon as well. And choosing the best pair to trade, well, this was a recent strength meter for what currencies were pushing at the moment. So as you can see here, Norwegian krona, British pound and the euro were very, very significant. So against the dollar, because obviously we always look at dollar pairs when the NFP comes across the board, when the NFP is coming forward, we are looking to see what is good to trade against the dollar. So at the moment, the pound and the euro, if it's a negative NFP reading, then the pound and the euro will be good to trade against the dollar. However, vice versa, on top of that, you have the Swiss franc and the Kiwi and the Aussie and the yen. That will be quite good to trade against the dollar if we do have let's say a positive NFP reading, because it is quite significant that we reached the 500,000 predicted job number. Otherwise it will seem like a little bit flat NFP, which brings us on to our final slide, which is how to protect my risk capital. So this is just a few points that we always go to when we're trading in general. Even the seasoned analysts still pick up these points and trade by these points, just so that they're protecting their risk capital at all costs as well. So let's just take a few notes here. So number one, avoid trading during the NFP as volatility is high and the whipsaw effect could lead to losses that exceeds profits. So this all comes down to, if you are not experienced in trading high fundamental impact news events such as the NFP, excuse me, where the volatility can be high and the whipsaw effect is just basically, it's one moment it's high, then it's down, then it's like this. It could lead to really big losses and exceed profits. So, you have to just make sure that you don't enter a trade at the wrong time, and make sure that you have your risk capital protected with pending orders such as stop losses and take profits, which we'll come into shortly. Number 2, apply protective stop loss and take profit risk management measures in order to bypass emotional hurdles. So pick it up on point 1. When you do have a fast acting market, you need to really make sure that your capital is protected by pending orders such as take profits, stop losses. Risk management is a valuable tool when trading, at least, and to bypass emotional hurdles. When emotional hurdles come into play, then there's we are really looking on the downturn. Then when emotional hurdles are, let's say, are part of your trading strategy towards the end, if losses do exceed profits, then it is difficult to bypass them. You're really wanting, let's say, euro dollar to peak up after it's lost 50 pips, and if it keeps on pushing further, you leave that trade open for a little bit longer and a little bit longer, hoping that your emotions will push it higher. But obviously it doesn't, and then you could be stopped out, or at least get on a margin call, which nobody wants to do. So just to protect those emotional hurdles, and obviously, as I said, risk management is very, very valuable as well. Number 3, close out all positions, if any, ahead of the release in an attempt to divert from high volatility risks. So if you don't want to get involved in high impact fundamental news events such as the NFP or any kind of interest rate release or anything like that, just close out all your positions and wait for the market noise to calm down. Market noise is something we'll check on the next point, but it's something that it's like a ripple effect. It can go on for a few more hours after the news event, even though the main action is a few minutes after the news event. The actual data can keep coming out of the economy, of the news that it's impacted on, and this could have serious repercussions on the currency pair or even the commodity or stock or any instrument that relates to the news event. So just something to pick up on there and be careful with. Number 4, hedge your positions if you have any ahead of the release in case your risk is minimum, but you trade long term and the stop loss is far from being hit anyway. So hedging can be a very, very good trading strategy, but you just have to remember to use it correctly. If you do have, say, one lot, for a basic example, one lot of euro dollar in a hedging position, buy and sell, then the fact that the market might spike 100 pips in one direction, you still have a risk of being stopped out because your market, your margin level could actually drop to the stop out of, under the stop out range. So you just have to be careful that hedging your position doesn't guarantee that you're not going to be directly affected with high impact news events as well. So number 5, if you're eager to trade despite the warnings, do let the markets calm down before entering a trade. That way you circumvent the heated environment and also have a clearer picture as to where the markets could be heading towards as market noise is reduced. So that was picking up on point 3 as well. Market noise can keep on pushing until maybe the session is out. I mean, the American market is opening now, and we could see ripple effects of the NFP keep on pushing until the afternoon in America. This is how volatile and worrying the trading news could be. So if you're eager to trade this despite the warnings, do let the markets calm down completely. Wait until you're out of those ranges as well, and then you can enter these trades a little bit more cooler, let's say, than the heated environment, than when the fundamental impact news has actually hit. So just something very, very important there to keep an eye on as well. Number 6, analyze the data post-release. So without supporting employment, wage and unemployment data, any directional trade is at risk of a reversal despite the NFP being over, as post-effectual bias depends on all 3. So, we're analyzing the data now pre-release, but also post-release is just as important because, as we've touched upon with the presentation, you've got unemployment data, we've got ADP, we've got weekly jobless claims, we've got inflation, but there's all sorts of things to tie in. There's the Fed making weekly comments about tapering, about inflation rates, about buyback borrowing, about all sorts of things that could really affect the market. So in this kind of environment, we have to just make sure that looking at a post NFP world is just as important as the pre as especially if you're wanting to put in those bids as well. Also, pay attention to the divergence between actual and consensus. So gaps of 20 to 30k are not considered very effective. So let's say now we have an NFP that's nearly, well, it was 500,000 that it was supposed to come in as. If it comes in as 450,000, just slightly lower, it might not be that significant, or it might not be that much of a move in the market because we are close to the projected number. However, if we do get a gap like last time around of 515,000 jobs that were missed, then we saw quite a big move in the market at the time. So, and these moves can happen in the first few seconds. So we can jump to like 30, 40 pips easily in the first few seconds of an NFP release. And also it can actually push higher as we go into the first 10 minutes after, well, 5 minutes after the NFP release as well. So just pay attention to divergence between actual and consensus as well. And this is picking up on the actual news itself. So at the moment we've got 235,000 from last year, from last month, 500,000 for now. So that's just roughly over 250,000 jobs, which is quite a large amount, let's say. But if it was anything smaller, then we could expect a bit of a non-performing payroll, and the job numbers will be quite flat, and so will the market. So we'll see shortly what that actually means. So as we go into as we finish the presentation, just want to start looking at some of the charts now. So I've picked a basket of the main charts that I look at as I go into the NFP. So these are all on 1 hour charts. I'll just put them in the 4 hour. This is for euro dollar. So these were my levels before we started to move slightly down. So for me, this was for a few sessions ago where we started moving lower and lower and lower. But now, as you can see, I'll just delete these so there's no confusion. So now what I'll be looking at, if we do get a little bit of a negative data, or if the data has already been priced in because the euro dollar has been moving quite significantly, then this could mean that we could be looking roughly, first of all, I'll be looking at the psychological handle of 116, which is roughly about here. I'll be looking at it to test that. And then after that, I'll be looking at roughly the previous low, 115.28, 115.30, let's say. So that's about 30 pips away on each side, which isn't really out of the question. I'll just put it on a daily chart just to show you even more levels that I was looking at before. Obviously you've got the 113 handle, that's a little bit far away, but let's just go to roughly another 30 pips to the downside. So that's another at the 115 handle. So this is quite significant because we haven't actually seen these levels at 116 since 5th of November 2020. So this is looking like it could be another leg to the downside. As you can see, that trend, if you look at the levels here on the daily chart, the trend is actually quite significantly to the downside. So if we get another push to the downside, then we can expect possibly another move, and it'll be very, very interesting how that plays out. So that'll be the levels that I'll be looking at as for the euro dollar. Pound dollar, again, this is on the 1 hour chart. I'll just zoom out a bit more. Very, very choppy action at the moment. Not really much point in putting a Fibonacci or anything on there because of the choppiness. 136.50, 136.47, 46 is what I'll be looking if there's a push to the upside. As you can see, there's a nice move there to the upside, which I'll be looking to see. Nice trend to the upside, looking to see if that's going to be broken. If it does break, I'll be looking at the 136 level or 135.90 level. Again, another psychological level there for sterling. And let's just put that 136 in just to see where we are for where the data starts coming out, which is very, very soon. Gold, I just want to touch upon as well before the figures come out. It's been trading in a $20 range for a while at the 1750, 1770. And I'm just waiting for the break to the upside or downside to confirm. We've had a couple of false breaks here to the downside, but now I'm just looking to see if we're going to have another leg up and then possibly break. And then, we'll be going higher and higher, potentially. If we look at the daily chart, the last time we had a break and supported break above the 1770 was in September. So again, is it going to come into fruition anytime soon? We'll have to wait and see. And we'll just drop that down until the data starts coming out. We'll just do a zoom in here and a zoom in here. As I said, oil is something to look out for as well, since we've had a peak at $79 again, or push to $79. We're looking again to see if that's going to be the case as we enter the final moments before we get the data. Dow 30 as well, something just to keep an eye out for. Very, very significant gains in the last few trading sessions, now going into a choppy sideways pattern. So I'm hoping that we're going to see another move to the upside. However, it could be a little bit few and far between, as we are seeing that the Dow is trading a little bit flat today. Well, for the last few sessions, if we look at the last time that the Dow really broke out into any significance, it was in October. So here we go, then the markets have started moving. Also, we've got some CAD news as well, unemployment data, so that'll be interesting to see what's going to come out of that. Unemployment change for the CAD is in line at 6.9%, and we are looking at an employment change of 157,000 versus 65,000, so quite significant there. And non-farm payrolls reported at 194,000, so a big miss there, a very big miss for NFP data. We'll see. So a very, very big miss there for the NFP. So that's why we're seeing a bit more of a spike, a bit more push on the euro and the pound. So looking at a bit of a weak dollar overall. There you go. There's the gold, looking at heavy resistance at the 1,770 level. Can't seem to get the numbers out of my mouth. That'll be interesting. If that breaks, I'll be looking to put a bid price, position in there for it to go higher. But looking at a weak dollar across the board at the moment, even the dollar CAD, Canadian employment data has come in quite significantly. And even the part-time and full-time employment has really pushed higher. Full-time employment change, almost 194,000 versus a 40,000 forecast for that. Unemployment rate has crept down to 4.8% in America, and this was at a consensus of 5.1%. And a previous number of 5.2% as well. So we've got the wholesale inventories month on month later for America, but this is obviously the main talking points at the moment. So like I said, looking at this for the pound, if it does give a supportive break over the previous high, then I'll be looking at a buy position there. Gold, it looks very tentative there. It looks a little bit worrying that it's not going to get over the 1770 handle. Hopefully it does, just to give us a little bit more of a break to the upside at least. And dollar yen, almost a full doji, almost a full reversal now for the dollar yen. I wasn't really expecting much of the dollar yen because it hasn't really been performing very well as late. So, you know, we had that spike to the downside, 111.53, but I mean, it was always going to be difficult to really cement below the last spike, which is here at the 111.70-69 region. So significant there. And the S&P just moving slightly lower as well. So not a very good day for America at the moment. Obviously prices are reversing quite fully now, but we might get another leg to the upside. Gold is going for it again, trying to just burst that 1770 handle, and we'll see if that comes into fruition. And as it just spikes, but just retreats slightly as well. So again, we'll see what happens with that. So as the presentation was, as I said on the presentation, you know, if you're looking at steering clear of the market noise, let the market effects cool down a little bit. As you can see at the moment, we didn't really get a performing payroll. Numbers were pretty flat. Expectations were missed. So it's looking like it won't really have much of a ripple effect for the rest of the trading day. So we'll just see if there are any updates coming in. So yeah, 194,000, the lowest so far this year, and well below forecasts of 500,000. So very, very worrying numbers. But worrying numbers for Joe Biden. And obviously, as we go into the holiday season for a lot of Americans in the next couple of months, we'll see if job numbers, or part-time job numbers at least, increase due to the demand of the holiday season. And it's still saying that the country is still 5 million people out of work in the hospitality and leisure and business services. So again, very significant there. So we'll see what happens in the next few trading sessions at least. So as we come into October now, as I said, the start of quarter four, we'll see what is the main impact for a lot of companies, a lot of businesses. Always look on the ADP data, very significant, and always look on the weekly unemployment jobless numbers as well. And as you can see, we have finally spiked above 1770. So hopefully now we will have more impetus to the upside. Let's get that on a 4-hour chart. So, I mean, gold I usually start looking at every $10, so 17, 18, 90, etc. I don't think it's going to push that high at the moment. It's just testing this region at the moment. So I don't think it's going to push that high by this time the session's out. However, I hope there's not a full reversal neither. But the main significant point is we look like we've pierced the 1770 handle, and we are going to stay above it for the foreseeable future. This will look good for bulls especially, but we've got a lot of news next week as well coming in for the main American markets, which will be quite significant as well. Got retail sales data for the US next Friday, which is quite interesting. It will see if it can stay above the previous 0.7%. That's, to stay above into positive territory will be quite significant, and we'll see if it keeps on flowing as well. So into the first 5 minutes post NFP, as you can see, we've had on the euro dollar, pound dollar, even dollar yen, we've had a spike to the upside, well, a spike against the dollar, and now we are slightly reversed, almost full fold, and now we are just testing the waters again to see if these spikes are going to be hit again. I'm just more curious about gold, to be honest, because as you can see, we're $3 above the previous resistance level, and we look to be pushing a little bit more higher. It doesn't look like the indices are really going to give us anything significant at the moment. Very, very choppy with the Dow, and I'm not expecting really to test this region again. 34,708, 700 probably would be more significant. If it falls below there and stays below there, we could be hitting another leg to the downside, roughly to here. But again, we'll see if that comes into fruition. Same with the S&P as well, looking to see what the results are. These opportunities are. The S&P has done almost full retracement in the last few minutes, but again, I'm not really looking for it to break the 43.90, 43.91. If it does, like the Dow, we could be looking at another move to the downside, which will be quite significant for the indices. But the indices recently have had a little bit of a choppy action in the last month. The last week. So we'll see if that comes into fruition. Good data with Canada though, which is why we're seeing a little bit more of a move to the downside. Going toward breaking the 125 handle now. We'll just put that into context here. Breaking the 125, looks like it's cementing its place below the 125. And if we look on a 4-hour chart, as you can see, the downturn here that we've seen, very, very choppy patterns there. And it looks like the bias is firmly on the downside now. I'll put that 125 in just so that you can keep note of it. Just squeeze it down just to show that we are looking at the lowest levels since let's see, this is since the beginning of August, so over a 2-month low now currently. So it looks like the markets are very corrective and in line for another move to the opposite end. As you can see here, we've done another $5 move, almost 17.75 now. We've achieved that, so very significant. So my previous resistance, the fact that it broke that, a good buy stop there, and we would have achieved $5 depending on your lot size. It would have been a nice profit there. And also, as you can see, broken the previous resistance for pound, and another push to the upside as well. So we're just looking to see what the opportunities are in the next few hours as we enter the end of the trading week, and obviously the end closing soon of the end of the NFP presentation. But I will still stick with you because I'm very, very curious to see what gold will do, and also the pound and the euro against the dollar as well. So as I said, in closing with the whole presentation, just be sure that you've got your pending orders secured so that you're protecting your risk capital. No one wants to hit margin call and then stop out, which it will be very, very detrimental for your trade and portfolio. And you don't want to go below this 50% threshold of your capital, because then it will be very difficult to get that 50% back and then make a profit on top of that as well. So you're looking at 60-70% to claw back, well 50% to claw back, and then another 10, 20, 30% to get into a profit. So you don't really want to be going down that road if you can help it. So steer clear of all market noise if you can. As you can see, there's still a little bit of market noise lingering around, but there are good trades to jump upon. There could be a slight reversal in gold down to the 1770 handle if it doesn't keep pushing up further. Gold, pound is looking to push a little bit higher as well. I'm just looking at the next peak here, 36.72, so that's only another 30 pips, which is possible in the short term at least. And dollar yen, as you can see, we're moving a bit further down now, so we've cracked that previous spike on the left hand side there, and now we're hitting another low. So 111.50, quite significant psychological level, but there could be an even further drop to the downside as well. So a few things to look out for, and also obviously the indices as well. These are quite significant when looking at the overall picture of the American economy. The Dow, as I said, just spiking below that previous line, but if it spikes low again and maintains the downside, then as I said, I expect these levels to come in and drop to roughly 34,500. We lifted above that for the first time for a long time recently, and with the Nasdaq as well hitting the 15,000 mark, we'll see if that can have another leg higher as well. But for the moment, I'm just looking at the S&P and the Dow. Dollar CAD, always interesting. It's not every time that the NFP figures are coming out the same as the Canadian employment figures, but when it does happen, it can be more of a roller coaster ride for the Canadian pairs against the dollar, because that's very, very significant as well. So just a few things to look out for as we close the presentation. So that's all from me for this month's NFP review. As I said, any trading interactions that you want to have with us on our YouTube channel or on our blog at orbex.com, feel free to contact us at any time, and we will get back to you as soon as possible with any of your questions. This presentation will go on our YouTube channel as well, so any comments that you'd like to add, feel free to do so, as I said, and any conversations that you'd like to have about any of the indicators that we have on our website. This is regards and any any indicators such as Elliott waves, Ichimoku cloud, even simple RSI or oscillators. This is the place to do so, and we'll get back to you with 100% guaranteed getting back to you. I forgot the word now, but this is basically we'll get back to you 100% guaranteed, and it will be very, very good to hear from you. Any feedback as well from the NFP, anything that you're expecting. I was expecting a closer number to the 500,000 than it got, As I said, it was the lowest in a long time at 194,000. So I'll be probably looking on the forums as well, speaking my own mind about what I thought of the NFP, a little bit of a flat NFP, and also just where you think that some of the instruments may go, gold, forex instruments, and also commodities and equities as well. So feel free to talk about anything on the blog and on the video as well. And we'll catch up next time. So have a great trading weekend, and bye for now.